Hello, everyone. Welcome to our latest episode of our podcast, Everything Tax. I'm Prateem Sengupta. I'm a partner with the Director International Tax Practice of Andersen, UAE. I have Aditi Gupta, who is a manager in a corporate international tax practice. Happy to have you, Aditi.
Likewise, Prateem.
So today we'll be talking about a very important and I think a very practical topic that we have for you, which is the upcoming corporate tax return. And we'll be talking about certain practical aspects around it and challenges that you may face. With that, I think we can start the session where before we get into what the form is, right, Aditi, I think it's very important to talk about some of the prerequisites before we even start filling in a tax return, right? So what would be some of these requirements, Aditi?
Yeah, I think that's a very important part before getting to the form itself. There are a few things which the businesses needs to be mindful of.
Yeah.
First being they need to have their audited financial statements in place. So as majority of people will be aware that audited financial statements are required in case your turnover exceeds 50 million.
Yeah.
So in that case, you'll have to attach your audited financial statement to your return form.
Okay.
And in case the turnover is less, then you can have a management certified but IFRS compliant financial statements.
Okay. And here I think it's very important. So when we're talking about this audit requirement, right, this flows from the corporate tax law. But in our experience, I think something that which we have noticed is that sometimes audit requirement could also come from the company's law, right?
Absolutely.
That is a separate requirement which businesses may want to check.
Yes.
And not just go by what the corporate tax law is saying, right? And ultimately, also, at least in my experience, I have seen that tax authorities are a bit more okay and a bit more comfortable when you present an audited financial statements as against when you're not. But again, I would say that the UAE corporate tax law is quite balanced that way and progressive. Just balance it out with the the complexity and turnover, right?
That's right.
But we always kind of advise that have audited financial statements wherever you can. That's a very important point. Anything else, Aditi?
Yeah. So basically, when we talk about financial statements itself, for example, if there are companies which are going for a tax group, that's an important aspect if you see here, because there they need to prepare separate financial statements, consolidated financial statement for the entities which are forming part of the tax group. And this could be different from the actual consolidation because, there could be instances where a lot many entities are there which are subsidiaries of a particular entity, but only a part of it are forming part tax group. So that way they have to prepare separate tax aggregated financial statements. I think that is also an important aspect.
And that is, I think, what right now we are also seeing practically that a lot of groups are working towards it. And I think one thing that I want to add, Aditi, is here that I think recently a new FT decision has come in, which has kind of given new guidelines and rules as to how to prepare these special aggregated financial statements, right? And there are a few unique points to it and, how you don't have to consider business combinations and how to go about, eliminating certain transactions. So I think it's very important. While I think that decision applies from 25 onwards, I think a lot of guidance can be taken from that decision and what I think the FT is looking for when you're doing this aggregation. So I think groups should be mindful, while preparing 24 aggregation. It's another question that if you've already aggregated and filed your tax returns, what you can do, that can be planned and maybe more practical steps can be taken for that. But yes, I think for the ones who are yet to prepare, I think this new decision can be taken in consonance, right? Yeah. Beyond this, Aditi, any other points?
Yeah. So basically, if you see, there are certain entities who are preparing financial statements in other currencies. It could be USDs and Euro. But the portal only allows you to fill figures in AED, which is dirham. So therefore, it's not required to have the audited version in AED, but you need to have a record wherein every figure is converted into dirhams. So that is something which they can, keep handy before.
And this we've mainly seen in multinational groups, right? Where I think sometimes, they have to report in USD or other. USD is practically not challenging because AED is pegged to the USD. But if it's any other currency, that may have to be, you have to kind of be mindful of. Especially also what rate you've I think in some places we've seen that even the USD and AED, the conversion rate is not the central bank rate, right? So they've used slightly different. So I think that's a very, very good point. Apart from this, any other additional points?
I think one more important aspect is, if at all you have qualifying immovable properties. So, and if there is any sort of sale or transfer that hasn't happened in the current year, so there you'll have to obtain a valuation report for 1st of January 2024. That is the beginning of your first tax period. So I think if at all there are entities who have qualifying immovable properties and there are transfers in the current year, even though they're not transferred in the current year, we still recommend them to have a valuation report in place for first date of the tax period.
Yeah, I think, this is a good, documentation requirement. I think you should have, it's a good to have this already in place, because I think it will also fill in some numbers and some, kind of disclose that, right? While you're filling in the tax return. I think these are very, very good points. I think the key takeaway being that ensure that your financial statements are ready, audited, your valuation reports are in place. And I think one other key point I would say from financial statements is that ensure that the financial statement, if you're not a tax group, but ensure that it is standalone, right? We've seen groups where UAE is one company, but it has subsidiaries outside UAE. And and when they're making the financial statements, they're combining these outside UAE entities also. This is not a standalone financial statements. You'll have to ensure that you're preparing only for UAE and the UAE entity. And moving on, when you spoke about valuation report, right, that brought my thought to these elections that you have to make, right, while filing your tax returns. Can you just run us, Aditi, through these elections? What are these elections and how do they impact the return form, right, ultimately?
Yeah. So, starting with the first election, which you just spoke about, which is Ministerial Decision 120, which talks about qualifying immovable properties, qualifying intangible assets, and qualifying financial assets. So under the law, there's an option that you can grandfather all your gains up till your first tax period beginning, which is, if at all, by an example, if you've acquired an asset prior to 1st January 2024, sometime in 2010, 20, whenever, and I'm selling it in the current year. Or for example, in future year, I have an option that I can grandfather gains up till 1st January 2024 to not to be taxable. Okay. And that's an election which one needs to make. And this election is a one-time election. So basically what and how this election helps is that if at all you select for an election, here, basically, it will help you grandfather your losses even in future years when you're making the sale. The only requirement is that asset should have been acquired prior to first tax period.
Understood.
Plus, it should be at historical cost.
Understood.
So if you're complying with both, you can go ahead with this election. And we definitely suggest our clients also that even though there is no transfer in the current year, we still opt for option yes, such that in future year, when the transfer happens, we can still benefit from this election.
And the critical part here is that you have to select the option, right?
Yes.
This year.
Yes.
Like if you have the asset in your books and you meet the conditions, you have to make, even though you're undecided, you have to decide.
Yes.
Right. That is a call that needs to be taken.
And it's a one-time call. So it's a one-time election.
And anything else?
Yeah. Another important election is a realization basis election.
Okay.
So basically what is there in this election is you have three options under this election. One is no realization, wherein whatever gains or losses which are there in your books are or can be recorded as is in your tax books as well. So no adjustment is required for any sort of unrealized gains or losses. It could be as is basis. The other is realization basis election, which is for all the assets. So if at all in your books, there are any sort of gains and losses which are on unrealized basis. Say, for example, provision for bad debts. Say, for example, any sort of forex gains or losses on your investments. All of these cannot be realized or recognized in the current year. You can opt for that option. And in the year when you're actually doing the actual realization by way of a sale, transfer, or any other sort, in that year you book it.
Okay.
So that's another option.
Okay.
A similar sort of option, which is also a relevant option for many businesses, is a third option, which talks about realization basis only for capital assets.
Okay.
So here, the revenue nature items or current account can be done on unrealized basis, but the capital account items, you can opt for realization basis and not record any sort of unrealized gains or losses in the current year. So while you're filing your return form, this is also a yes or no election.
Understood. So it's important to do this election analysis before you file your tax returns, right?
Yes.
And it's very critical. I mean, I guess it's more complex than what it appears to be. And I think, whether everything should be unrealized and what are these gains and losses is also critical, right? I think somewhere we feel and we've experienced that people sometimes get confused between revenue and expenditure with gain and loss,
Yes.
right?
Yes.
This only covers gain and loss. Like you said, like maybe like an ECL, right?
Absolutely.
Or a fair value gain on your properties, right? So these are gains and losses, but not revenue and expenditure linked to those assets, right? So I think that's a key distinction that maybe even teams must look out for when doing this in election analysis. Any other elections which are critical?
There are many more elections which needs to be made, but they're annual elections. For example, one is small business relief.
Yeah.
So this is an annual election which is available until 2026, wherein if your revenue is below 3 million dirhams, in that case, you can opt to file for a simplified return.
Okay.
So therein you don't have to fill in, all the data which is required for a normal return. You don't have to put in all your accounting data, your balance sheet items, your P&L in the form. It becomes a very simplified form. The above elections we spoke about still remains. Okay. Those elections still needs to be made, but you can opt for a simplified return. And it depends on year to year. So this is an annual election.
Okay.
Yeah. Other than this, there are certain other elections, one is business restructuring relief. So this election again depends upon the transaction. Okay.
Yeah.
If at all in current year I don't have a transaction, I don't have to make an election. It's per transaction basis.
So it's not it's only if you have it, you need to do it.
Yes,
right.
yes.
Okay.
And a similar sort of election is relief for transfer within the qualifying group. So this election is also, as said, at least under the guide, a one-time election. But this election only triggers when there's a transfer. Yeah. So for example, in the current year, I don't have any transfer within my qualifying group. So I don't have to make this election. I select no to the transfer, no election option comes.
Yeah.
But in the next year, if I have a transfer, in that case, I select for option yes, then that applies for all the future transfer that happens.
Understood.
So it's a one-time election, but not for the first tax period. It could be for future.
Understood. Period. And then I think there's also an election for, I think again, that if you have it, you do it. If you don't, like say if you have a branch outside UAE, you're a company and a branch outside UAE, right? Branch is usually taxed in the other country. You can choose to elect that this branch should not be consolidated with the UAE entity and to carve it out, right? And we call it a foreign PE technically, but it's nothing but ensuring that your branch is not doubly taxed. It's not taxed again. So I think this is also something that you need to kind of be mindful of when you're filing your returns, because we've seen that a lot of businesses do have a branch set up, but they think that it's a subsidiary or vice versa, right? And I think it's important. Very, very important, I think, when you spoke about small business relief, right? I think for the audience, I think what is important is that small business relief, yes, it's simplified, but you're getting something, but you're giving something also. So if you're a loss-making entity, right, you will not be able to carry forward those losses. So there are some things that you get ineligible for when you do this, right? And I think before doing this, do a detail. So the motto is that do a detailed study and then look at your elections and get those in place, right? And now we've covered what to do just before starting to type in the form, right? And now when you fill in the form, are there any things that you thought, these schedules are additional information and something that needs to be filled in? Did anything strike you from that perspective, Aditi? Yeah.
Yeah. So basically, Prateem, you see, now when you talk about schedules which are there in the return form, it is very much dependent upon the kind of transactions that you've had during the year. So while we generally do provisioning for our clients, we kind of notice what all are the different transactions.
Yeah.
For example, if at all there is any sort of participation exemption, which an entity has, right? We spoke about immovable property. If at all any entity has any immovable property, all of these separate and different transactions hit a different schedule.
Okay.
Yeah. And in the return form, when you open it, you can download those schedules, you can fill in and keep them pre-ready again. So what happens is, for example, if you have a qualifying immovable property and there's transfer, if at all I wait until I'm actually filling the form and I see that kind of detail that is required there, it might become a very cumbersome task. for the businesses. Okay. For example, as we spoke about immovable property, you'll have to mention what was the date of ownership for each and every immovable property you have. What is the address? What was the actual ownership cost when we acquired? What was the acquisition cost? Right? If at all it's sale, what is the date of sale? Right? If at all I'm gaining the benefit of MD 120, what is that gain that is going to be grandfathered? Yeah. So all of those details are something which needs to be mentioned in case of this particular transaction that we spoke about. But if we look at foreign PE exemptions, right, there also I'll have to mention the jurisdiction, right, from where I'm getting, whether there's a 9% tax or more, right, the condition that we see for participation exemption and PE. All of those are separate and different kind of schedules that are there in the return form. And depending upon the transactions that the entity has done over the year, they'll have to see what all, schedules come to play for them.
And, moving from that, right, we spoke about when the business is mainly, like say, regular paying business, right, regular tax paying. Do you see it gets a bit more complex and there's more data that's required or information that's required when you are a 0% entity, like say a qualifying free zone person, right? Where earlier there was an ESR law, right, that got repealed. It's kind of partly got subsumed by this qualifying free zone person law within the ambit of UAE corporate tax law. Is there any additional disclosure that a qualifying free zone person needs to make?
I think that's a very important aspect, Prateem, qualifying free zone person, because generally the way people or the businesses see is that since we have a 0% taxation, there is no additional requirement.
Yeah.
They kind of get relaxed and laid back.
Yeah.
But when you are a qualifying free zone person, in the return form, there's an additional details column that come which needs to be filled in by the businesses. For example, if to start with, we'll have to first of all know what is the qualifying revenue. Right? You have to put in the figure for qualifying revenue. When we talk about non-qualifying revenue, each stream of non-qualifying revenue, whether if at all there's any transaction from an excluded activity from which you're getting revenue, you have to put it separately. Any revenue earned with a free zone person who's not a beneficial recipient, that has to be put in separately. Any transaction from where the revenue is coming for a transaction with non-free zone person, with a non-qualifying activity. So these are the different kind of segregations, the detailing that the FT is looking for when you're actually claiming that 0% taxation. They have to see whether de minimis is breached, not breached.
And do you have to kind of give any kind of confirmations about the conditions also being met?
Yes. For each and every condition, like for the 6 conditions that we have for a qualifying free zone, they'll ask you to tick those boxes confirming that you're satisfying each of them.
So it's almost akin to a declaration, right? That you're like kind of giving confirmation that I meet these conditions, and those conditions, whether you meet or not, is based on some sort of analysis that you should already have in place. So I think it becomes very, very critical that businesses do this and before filing the qualifying free zone person, right? And one more thing, that once we think it's 0%, right? Do you still have to compute a taxable income in a regular manner for qualifying free zone person?
Yeah. That is also there because, there are certain streams of income, right, which are not eligible for 0% taxation, even if you're a qualifying free zone, right? For those, you'll have to bifurcate your expenses which are pertaining to qualifying revenue, which is there, and to these other income streams which are mentioned, like if at all you're obtaining any sort of revenue from commercial properties, right? Commercial properties with a non-free zone person in a free zone, right? Any sort of income from a property, immovable property, which is not in a free zone itself. So those different sort of income streams and the expenses attributable to them is something which has to separately come out.
So this is some things that you touched upon while filling in the form, right? I fill in the form now and I proceed and I click submit, right? One thing is that, do I need to pay the tax immediately or I can wait and pay it? Because the law says that I need to pay tax only 9 months after the financial year. But do I need to pay it while filing the tax return? I can wait till 30th September.
No, so absolutely. I mean, I think it depends. For example, if you're sitting today and if someone is filing returns, say, for example, in August or early September, you still have time until 30th September.
Okay.
Because the due date is same. For return filing or for payment of taxes, the due date is 30th September. So you may very well pre-file your return, but, wait, or maybe because of whatever reason you're not able to pay the taxes now. You can still pay it until 30th September and not pay any sort of penalties and all. Nothing get triggered.
Okay, so you have to meet the timeline of 30th September, but you can make it anytime before that.
Absolutely.
Okay. That's great. And now one thing we spoke about corporate tax return and corporate tax filing and elections and everything. One thing I think seems, kind of missed or ignored is transfer pricing, right?
Yeah.
Now we know that transfer pricing requires you need to not, just to summarize, you need to have your intercompany or related party transactions and even connected person transactions at market value or arm's length. Not getting into the nitty-gritties of that, but as a compliance requirement, what is required from TP while filing the corporate tax return?
Yeah, so Prateem, basically in the return form itself, there's a separate section for transfer pricing disclosure form.
Okay,
but it's not applicable for everyone. The way it works if at all any entity has total transactions with related party above 40 million dirhams.
Okay.
In that case, TPDF triggers.
Okay,
so you have to check. There's a checkbox that needs to be selected. If at all you opt for it.
Yeah.
Okay. Now, when does the disclosure requirement come? The disclosure requirement comes for each transaction if a transaction with related party exceeds 84 million.
Okay.
So that's when you have to disclose a transaction, the nature of the transaction, the amount.
So it's one nature of transaction. So basically, if I'm making a royalty payment, so I'll check the royalty payment entire transactions with all my related parties. It's not transaction by transaction, but it is the type of transaction threshold.
Yes.
Okay. Very interesting. So overall, I aggregate all my related party transactions and check 40 million. And then I need to report those transactions, the type of transaction which exceed 4 million, right?
Yes.
Okay. And I think this is important. I think this form is quite standard globally. If I look at it, majority of countries have required taxpayers to file this form along with the corporate tax return. I think what is also important that you also disclose the transaction value and also the method that you use to kind of bring it at arm's length, right?
Absolutely.
And it's important to have these local files and master files in place that kind of back up the pricing policy that you have. And again, I think local file, you don't have to file it, but you have to maintain it at the time of filing return. So it's important to kind of maintain it contemporaneously, like we call it, right? So that it's the most updated and it's maintained at that time. So any other, points or finer points that Aditi, you think that maybe, how would you say that right now when we are sitting middle of August, right? What do you feel, that businesses must focus on right now? And then how would they kind of meet the timelines?
Yeah, just to add up here, the earlier thing that you were discussing about transfer pricing disclosure form, there's one more additional thing as we talk about connected persons.
Oh, yeah.
So there also you'll have to see whether the transaction or the payment that you've made to the connected parties in aggregate exceeds AD 500K.
Okay.
So that requirement also taps in.
So this could be bringing KMP remuneration. And I think this is so subjective. And I think that's a very good point.
Yeah.
It's so subjective and businesses have to figure out how to kind of, obviously we are there to support and how to benchmark this KMP remuneration and ensure that reporting also be done. And 500,000 is not very high, right, for KMP. So a lot of KMP remuneration would fall under this bracket. Right?
Yeah.
And I think, I think this has been a very, very good chat and a discussion on, firstly, what are the prerequisites? What are those aspects and challenges that we have encountered while filing a tax return, and what we can plan, and how to plan better for the future. Thank you, Aditi, for your insights and giving the audience some practical inputs as well, what you've encountered.
Thank you so much, Prateem. I think it was a really good discussion and I think an informative discussion, because what I feel is now is the time when businesses should really be focusing, right? This is the first tax period for them. And I think this should be of utmost importance given the complexity that can happen depending upon the businesses that are there.
Thank you, everyone. Thank you for tuning into this episode of ours. And do remember to follow us on our socials as well.